Types of bonds. 1. Government bonds. Description: issued by national governments. These bonds are considered low risk. Pros: backed by the government, making them very secure. Typically offer lower interest rates but are stable. Cons: lower returns compared to other bond types. Interest rate risk: if rates rise, bond prices fall. Risks and rewards. Risk: inflation can erode purchasing power over time. Reward: reliable income stream with minimal default risk. 2. Corporate bonds. Description: issued by companies to raise capital. They come in various ratings from investment grade to junk bonds. Pros: higher yields than government bonds, especially junk bonds. Potential for capital appreciation if the company performs well. Cons: higher risk of default compared to government bonds, especially with lower-rated companies. Risks and rewards. Risk: company bankruptcy can lead to total loss of investment in junk bonds. Reward: higher interest payments and potential for price appreciation. 3. Municipal bonds. Description: issued by states or local governments, often tax-exempt at the federal level, and sometimes state/local. Pros: tax advantages make them attractive for high-income earners. Generally safer than corporate bonds but riskier than government bonds. Cons: lower yields compared to corporate bonds due to tax benefits. Risks and rewards. Risk: economic downturns can affect local governments' ability to pay back debt. Reward: tax-free income and relatively low default risk. 4. High-yield bonds, junk bonds. Description: corporate bonds rated below investment grade. They offer higher returns due to increased risk of default. Pros: attractive yields that can significantly boost portfolio returns if managed correctly. Cons: high volatility and greater chance of losing principal investment during economic downturns or company failures. Risks and rewards. Risk: default risk is high. Investors may lose part or all of their principal if the issuer fails financially. Reward: potentially high returns that can outperform traditional investments during favorable market conditions. How to begin investing in bonds. 1. Assess your financial goals. Determine your investment horizon and income needs before choosing bond types. 2. Research bond funds vs. individual bonds. Consider whether you want direct ownership, individual, or diversification, bond funds. 3. Open a brokerage account. Choose a reputable brokerage platform that offers access to various bond markets. 4. Start small. Begin with smaller investments in diversified bond funds before moving on to individual securities. 5. Monitor your investments. Keep an eye on interest rates, economic indicators, and your portfolio's performance regularly.